The book Reminiscences of a Stock Operator is an investment classic that brings the story of the great speculator Jesse Livermore to life. Having won and lost tens of millions of dollars playing the stock and commodities markets during the early 1900s, Livermore brings to the table valuable analyses of market movements as well as profound insights into the motivations, attitudes, and aspirations shared by every investor or trader. In this video, we have gathered the most important takeaways from investment perspective, the timeless principles that will enrich your life and your portfolio. Please subscribe in order to stay tuned. There is nothing new on Wall Street. There can't be, because speculation is as old as the hills. When you read contemporary accounts of booms or panics, the one thing that strikes you most forcibly is how little either stock speculation or stock speculators today differ from yesterday. The game does not change, and neither does human nature. Fear and hope remain the same. People will continue in the future to make the mistakes that they have made in the past. Weapons change, but strategy remains the same on the New York Stock Exchange. There is nothing like losing all you have in the world for teaching you what not to do. And when you know what not to do in order not to lose money, you begin to learn what to do in order to win. Did you get that? You begin to learn. So here is what Jesse Livermore learned after losing a few fortunes on Wall Street. The game of speculation isn't all mathematics or set rules, however rigid the main laws may be. Even in my tape reading, something enters that is more than mere arithmetic. There is what I call the behavior of a stock, actions that enable you to judge whether or not it is going to proceed in accordance with the precedents that you have observed. If a stock doesn't act right, don't touch it, because being unable to tell precisely what is wrong, you cannot tell which way it is going. You can depend upon the tape 7 times out of 10. Of course, there is always a reason for fluctuations, but the tape does not concern itself with the why and wherefore. It doesn't go into explanations. The reason for what a certain stock does today may not be known for 2 or 3 days or weeks or months. But what does that matter? Your business with the tape is now, not tomorrow. The reason can wait, but you must act instantly or be left. A speculator must concern himself with making money out of the market, and not with insisting that the tape must agree with him. Never argue with it or ask it for explanations. Tape reading is an important part of the game. So is beginning at the right time. So is sticking to your position. But my greatest discovery is that a man must study general conditions to size them so as to be able to anticipate probabilities. In short, I have learned that I have to work for my money. The big money is not in the individual fluctuations, but in the main movements. That is, not in reading the tape, but in sizing up the entire market and its trend. No matter what gives a big swing, its initial impulse, or who later opposes it, the swing will inevitably run as far and as fast as the impelling forces determine. Not even a world war can keep the stock market from being a bull market when conditions are bullish, or a bear market when conditions are bearish. And all a man needs to know to make money is to appraise conditions. The speculator is not an investor. His object is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. Therefore, the thing to determine is the speculative line of least resistance at the moment of trading, and what he should wait for is the moment when that line defines itself, because that is his signal to get busy. My system for placing my bets. Now, the point is not so much to buy as cheap as possible or go short at top prices, but to buy or sell at the right time. When I am bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I am buying, the reverse is true. I must buy on a rising scale. I don't buy long stocks on a scale down. I buy on a scale up. I never want to buy stocks too cheap or too easily. In starting a movement, it is unwise to take on your full line unless you are convinced that conditions are exactly right. Remember that stocks are never too high for you to begin buying or too low to begin selling. But after the initial transaction, don't make a second unless the first shows you a profit. Wait and watch. Of all speculative blunders, there are few greater than trying to average a losing game. Always sell what shows you a loss and keep what shows you a profit. In the course of accumulating my full line, I go in and out of a stock many times while testing the market. This looks like an expensive play, but after the real movement starts, it pays well to be right at the right time. It is simple arithmetic to prove that it is a wise thing to have the big bet down only when you win, and when you lose, to lose only a small exploratory bet. If a man trades in the way I have described, he will always be in the profitable position of being able to cash in on the big bet. They say you never grow poor by taking profits. No, you don't. But neither do you grow rich taking a 4-point profit in a bull market. It never was my thinking that made the big money for me. It was always my sitting tight. That is one trouble about trading on a large scale. You cannot sneak out as you can when you pike along. You cannot always sell out when you wish or when you think it wise. You have to get out when you can, when you have a market that will absorb your entire line. Failure to grasp the opportunity to get out may cost you millions. You cannot hesitate. That a bull market has added to my bank account or a bear market has been particularly generous, I do not consider sufficient reason for sticking to the bull or the bear side after I receive the get out warning. A man does not swear eternal allegiance to either the bull or the bear side. His concern lies with being right. Observation, experience, memory, and mathematics are what the successful trader must depend on. He must not only observe accurately, but remember at all times what he has observed. He cannot bet on the unreasonable or on the unexpected. He must always bet on probabilities, that is, try to anticipate them. Years of practice at the game, of constant study, of always remembering, enable the trader to act on the instant when the unexpected happens, as well as when the expected comes to pass. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street, even among the professionals, who feel that they must take home some money every day, as though they were working for regular wages. Losing money is the least of my troubles. A loss never bothers me after I take it. I forget it overnight. But being wrong not taking the loss is what does the damage. I am so accustomed to losing money that I never think much about that phase of my mistakes. It is always the play itself, the reason why. In the first place, I wish to know my own limitations and habits of thought. Another reason is that I do not wish to make the same mistake a second time. A man can excuse his mistakes only by capitalizing them to his subsequent profit. In addition to trying to determine how to make money, one must also try to keep from losing money. It is almost as important to know what not to do as to know what should be done. In actual practice, a man has to guard against many things, and most of all against himself, that is, against human nature. The speculator's deadly enemies are ignorance, greed, fear, and hope. It is inseparable from human nature to hope and to fear. In speculation, when the market goes against you, you hope that every day will be the last day, and you lose more than you should have had you not listened to hope. And when the market goes your way, you become fearful that the next day will take away your profit, and you get out too soon. Fear keeps you from making as much money as you ought to. The successful trader has to fight these two deep-seated instincts. He has to reverse what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss may develop into a much bigger loss, and hope that his profit may become a big profit. It is absolutely wrong to gamble in stocks the way the average man does. A trader must know himself and protect against his own weaknesses. There is no need to feel anger over being human. I have come to feel that it is as necessary to know how to read myself as to know how to read the tape. The trading advice and keen analyses of market price movements in the book Reminiscences of a Stock Operator ring as true today as in 1923. There's a lot to learn from it by the thousands of people who buy and sell stocks speculatively these days, since the number of those who speculate profitably is still small. If you enjoyed this video, you are sure to like our other videos on trading. Thank you for watching.